you get a raise. You feel proud for about 2 weeks. Then nothing changes. Your stress level? Same. Your savings account? Still kind of disappointing. Your investments? Not growing the way you expected. And you tell yourself, I just need one more raise, then I'll start investing seriously. Look, if your income has gone up over the past 5 years, but your net worth hasn't moved much, you're not unlucky. You're paying a tax. Not the government's tax, your own. I call it the silent salary tax. And investors don't talk about this enough. My name is Nick, and I spend way too much time thinking about how income turns into assets. Or doesn't. If you're someone who keeps earning more but still feels behind financially, make sure to hit the subscribe button. On this channel, I Invest, we don't just talk about making money. We talk about keeping it, multiplying it, turning it into ownership. And today, we're breaking down the invisible force that quietly prevents that from happening. Here's what most people believe. More income equals more wealth. That sounds logical, but it's incomplete. Because wealth is not built from income. Wealth is built from the gap between income and lifestyle. And that gap is constantly under attack. The silent salary tax is what happens when every raise increases your lifestyle. Every lifestyle increase raises your baseline, and every raised baseline reduces your investable surplus. It's not one big decision. It's 100 small ones. And because they feel normal, you don't notice them. Let's run numbers. You make $60,000 per year. You get a 5% raise. That's $3,000. Feels meaningful. But after federal, state, Social Security, Medicare, you might actually see around $2,100 to $2,300. So roughly $180 per month. Now here's the key investor question. What happens to that $180? If it goes into index funds returning 8% annually over 20 years, that's roughly $106,000 from one raise. But here's what most people don't realize. That $180 rarely gets invested. It gets absorbed. Here's what usually happens within 6 months of a raise. Slightly nicer apartment, slightly better car, slightly more delivery, slightly upgraded vacations, a few new subscriptions. Nothing dramatic, just better. And because your income increased, you don't feel the extra spending. But your investment account does. Or rather, it doesn't. Look, this isn't about discipline. This is about human wiring. There's a concept called hedonic adaptation. It means whatever improves your life eventually becomes normal. New salary? Normal. New car? Normal. New rent? Normal. And once it's normal, it no longer feels like an upgrade, so your brain seeks another one. Companies design around this. The subscription economy exploded because small recurring charges feel harmless. Studies have shown consumers underestimate subscription spending by more than double. You don't feel $12.99. You don't feel $8.99. You don't feel $15.99. But your investable surplus feels it. That's the silent salary tax. People blame inflation for everything, and yes, inflation matters. But here's what investors understand. There's economic inflation and there's lifestyle inflation. They are not the same. If inflation averages 3%, but your expenses rise 7%, that extra 4% is your silent salary tax. And most people never calculate it. Let's say over 5 years you go from $60,000 to $80,000. That's $20,000 more income. Sounds significant. Now let's break down small upgrades. Rent plus $400 per month, car plus $250 per month, food and dining plus $200 per month, subscriptions plus $100 per month, travel plus $150 per month. That's $1,100 per month, $13,200 per year. That $13,200 invested annually at 8% for 25 years becomes about $950,000. That's the cost of micro upgrades, not this month, but over time. The real cost isn't the spending, it's the compounding you never see. On this channel, I Invest, we operate differently. Investors don't ask, "Can I afford this?" They ask, "What does this cost me in assets?" Every recurring $100 expense equals $1,200 per year. Invested at 8% over 30 years, about $136,000. $100 a month. $136,000 of future optionality. That's the silent salary tax in its purest form. When your fixed monthly expenses rise, your risk tolerance drops. High lifestyle equals low resilience. Investors protect flexibility. Consumers protect comfort. Different games. Now, you might be thinking, what's the point of making more money if I can't upgrade my life? You absolutely should upgrade your life, but intentionally, not automatically. There's a difference between increasing lifestyle and increasing liabilities. Upgrading health, skills, or time freedom? Worth it. Upgrading recurring obligations without thought? That's the silent salary tax. Here's how you eliminate it. Every raise, minimum 50%, goes straight to investments automatically, before you feel it. Keep housing and car upgrades slower than income growth. Protect the gap. Before adding any recurring expense, ask, what is the 20-year asset cost? That mindset shift changes everything. The wealthy don't win because they earn dramatically more. They win because they prevent lifestyle from catching income. They widen the gap. Then they invest the gap. Then compounding does the heavy lifting. The silent salary tax shrinks the gap quietly over decades. If your income has doubled in 10 years, but your investment account hasn't, you're not bad with money. You just never protected the gap. And the gap is where wealth is born. Look, nobody teaches this. Very few teach restraint. Very few teach identity. On this channel, I Invest, we think differently. We invest before we upgrade. We calculate before we consume. We widen the gap. Because that gap is freedom. Income builds lifestyle, but discipline builds assets, and assets build freedom. I Invest. And if you're watching this, you should too.